welcome back to the Wealthy Wellthy Podcast, where we explore the intersection of wealth, health, and entrepreneurship. In this episode, we're talking about everybody's favorite topic, taxes. But before you scroll past, trust me, this conversation with Rob Cook is anything but boring. Rob's a CPA, CFP, and a wizard when it comes to turning tax strategy into real financial freedom. He's the Director of Strategic Tax and Advisory Services at Bement Company, where he helps high-earning professionals and business owners keep more of what they make and build serious long-term wealth. We talk about how to legally reduce your tax bill, the biggest mistakes people make when it comes to tax planning, and why your CPA and your wealth strategist should absolutely be speaking the same language. Rob also shares the personal finance philosophies that guide his own life, including how he's engineered discipline, family, fitness, and fun into his definition of success. If you're ready to upgrade your tax game and rethink how you build wealth, this episode is a must listen. And if you'd like a complimentary 45-minute tax consult with Rob, click the link in the show notes to schedule your session. Enjoy my conversation with Rob Cook. Rob, welcome to the Wealthy Wellthy Podcast.
Well, thanks, Krisstina. Thanks for having me on.
I'm super excited about today's conversation. And, we're going to talk about this thing called taxes. And most people find taxes is extremely boring. It's something you give your accountant and don't think
you
twice
never want
about
to touch with a 10-foot pole, right?
Exactly. You really stressed out like right before April 15th, but that's about it. And I used to be that way until I really understood is that how much money I could keep in my pocket by just learning some basics and having a really close relationship with a tax strategist like yourself. And that got me really excited to want to even learn more and dig into taxes and create a real partnership. So before we talk about this thing called taxes, and don't drop off just because we said the word taxes, you're going to love today's conversation. And Rob's an accountant that has a really great sense of humor. So I think we're going to make today's conversation fun as well.
Well, watch out. You might be talking it up a little bit too much here, Krisstina. I don't know if I can quite live up to expectations.
All right. Well, we'll see. I have faith in you. But before we do that, and we're going to talk about this big, beautiful bill and how it's applicable to everyone listening one way or another. Share a little bit about you, Rob. What got you into the accounting field and specifically more tax? And did you just grow up saying, I want to be an accountant, or, give us a backstory?
Definitely not. To make a very long story short, I actually went to school thinking that I wanted to be a dentist. Now, for those of you listening to this, I'm 6'5", about 245 pounds. I am not a small person. And so my wife likes to joke that I could have never been a dentist because my hands would never fit into someone's mouth. But that's what I was going to school for. And along the way, I thought, well, I'll get a business degree because at least I'll know what I'm doing. I'll be able to better run my dental practice. And it just so happened that I was going to school at Brigham Young University, which happens to have one of the top 3 accounting programs in the country. And so when I was getting into the business school to potentially get a business major to better run my dental practice, I was like, well, if I'm going to get a business major degree, I might as well maybe try for the best one. And so I took a couple of accounting classes and I fell in love with accounting. I fell in love with accounting not because I wear a green visor and I have a pencil, a pocket protector and just absolutely love being buried in a cubicle. I fell in love with accounting because I love the story that numbers tell. And growing up as a kid, I was always the kid that asks, well, why, all the time. I was that kid that perpetually annoyed my mom, and karma is a B because my little kids are the same way. And I loved that in accounting, I could finally answer all of my why questions around businesses and investments. Why did people choose to do that? Why were they doing this? Why would they make that investment? Why would we choose to relocate over here? Why would we make this adjustment to operations or our business structure? It answered all of those things for me. And so it just opened up this world of answers for me just by reading the story of the numbers. But ultimately what I love is I love the personal side of things. And so being a corporate accountant or even necessarily like a CFO didn't necessarily appeal to me. I loved being able to see the application for us as people. And so I spent a few years in public accounting at Ernst & Young, a very large accounting firm. Actually wound up leaving and spending some time in wealth management and financial planning because I thought that was the world in which they really helped a lot of individuals, learned a lot of interesting things, and I'm not going to disparage that entire industry, but just quickly learned that it wasn't necessarily for me. I wanted to get into the nitty gritty. I wanted to do real strategy to really help people create a life that they wanted to live, not necessarily just collect some assets or sell some insurance, which is what it typically seemed to turn out to be. So came back into public accounting, and now I'm the director of strategic tax and advisory services at Bement Company, and I spend the 90+% of my time helping people save money on their taxes. Specifically applying a few key principles and using specific things that can help them save tens of thousands of dollars, even if they're pure W-2 employees. There's a common misconception that if you're a W-2 employee, you can't save money on your taxes, and that's a lie, period. But most accountants, I would argue, are really good historians, what I call, give me your taxes. I'm going to write everything down and put it in the right places in your tax return, but I'm not going to tell you what to do to save money on your taxes. So most of them are really good historians, but they're not good strategists. Whereas we try to be strategist first, historian second.
That's some good story. So much good story there. It reminds me a little bit of my story too, just coincidentally, is that I went to same thing, business school, not because I want to be a dentist, but I thought I wanted to make a lot of money. So the only degree that is connected to making a lot of money is business.
Yep.
And same thing, I thought, and if I'm going to get a business degree, I could do marketing or accounting. Sounds like that's all about the money. So I actually got an accounting degree. And then when I started to sit down for my CPA, I thought, I'm not sure I'm smart enough for this. I really don't like this.
Oh,
and
come on. I'm
I
sure.
worked for Coopers and Lybrand for about a summer after graduating and sat in the basement, what I called the dungeon in a cubicle.
Yep.
And it just turned me off of accounting altogether. So full circle, it's interesting that I do a lot of accounting work today just through, teaching money management and personal finance. But anyway, we share that story. I love that. And then two, something that you said also is that I don't hear I'm not sure I've heard anyone else really say that what you just said. And I teach this in my programming, and it's to fall in love because we both work with a lot of entrepreneurs. And so I'm talking to entrepreneurs who want to make the money, who want to grow the business, who want to do all the creative and scale, but they want to abdicate their financials to their CPA and bookkeeper. And what I try to share with them is a different mindset because they think I don't like the money, or it's tedious, or I'm not good with money, or I'm not good with numbers, like whatever their mindset is. But I always say the same thing that you just said is, no, when you really get in your books and understand your numbers, they tell you a story. They're talking to you. That's how your business talks to you, is
100%.
the language of the numbers that come through your financials. And so same thing. It's like your books actually can tell a story. So I love that you said that same thing. All right. So there's accounting. There's tax prep. And then there's tax strategies. So share the differences, because everyone listening, I'm guessing there's going to be a healthy percentage who falls in this category. And I'm talking to people all of the time. And very few that I talk to understand the two different things. And so I want you to speak on these. One, that the accountant or CPA that you started with as you grow and scale your business and or grow or scale your income, the one you started with might not be the same one you want to continue with as you start making more money. So you just outgrow your CPA in many cases. So I'd like to hear your take on that, if you agree with that and what you would say to that. And then the second thing is that, I don't know, I'd even say based on my experience, and just on my side, I'm curious what your side is that not all CPAs are created equal. 80% probably in that historian category, to use your word, and maybe 20% are really in the strategy side, and to really, illustrate the difference between the two and why it matters. So if you'll just dig into addressing those.
Yeah, happy to do that.
I'd be happy.
So first of all, will you outgrow your CPA? Yes, is the short answer. Just like everything in life, there are levels to the game, and just like life, there are levels to CPAs. Your CPA that you have when you first start your business is probably a great person and doing a good job with a small business, but there are very different challenges, very different opportunities, and very different strategies, you could say, that become unlocked at different levels. And if you're not familiar with them, you won't be able to capitalize on them. And I'm saying to a CPA, you won't be able to capitalize on them. And as the business owner, you will not get the benefits of them, period. The thing is, I think we all know this intuitively, but we don't ever really actually think about it, right? Like we all know that a college basketball player is very different from a professional basketball player, and a high school basketball player is not the same as a college basketball player. Like that's very simple and easy to do, easy to understand because it's a physical domain and we can literally watch it. But when it comes to your accountant and your CPA, it's harder to be able to see that because you probably haven't played the game of accounting before, and you are not able to actually watch and see the impact of the difference. And you don't usually go head to head, right? Like you typically see in like a sporting event. But it is true. There are things that I have seen and done working at Ernst & Young, one of the big four accounting firms, that a lot of my smaller firm friends will have never seen and will never get the opportunity to see, more than likely. Now, that is not a knock on the small accounting firms. They serve a very vital function. And honestly, we're not a giant firm anymore, but I like to say that we're a small firm that feels like a small town firm, but we have the expertise of a big firm, right? So we're a little bit unique in that regard. But the point still stands, right? Like you put me head to head with 99% of accountants out there, and I guarantee you I'm going to find thousands, tens of thousands of dollars more in tax savings than they will, just because of what I've done and the things that I've seen. Like, for example, how many people out there have ever asked themselves, how could I turn a yacht into a charitable deduction? Probably not many people. Right. Yeah, probably not, right? But I know how to do that. Or like, how do I structure my life and my business in such a way that I own it all and control it all? Well, I control it all, but I technically don't own any of it. Right? Like to own Robert Kiyosaki's phrase, right? You want to control everything, but not own anything. Well, how do you do that? I know how to do that, right? And I would argue that not every accountant knows how to do stuff like that. Or how do we make $10 million and pay zero in taxes? I can tell you how to do that. There's lots and lots of different ways to do it. It all depends on your situation. But unless you're playing in that game, in that field, you're not going to know how to some extent. And so, yes, you will outgrow your CPA. And the best way to know if you've outgrown your CPA is to just talk to another CPA who might be at the next level up and just have them take a free look. 99% of us are willing to do that all the time. Like I do free strategy calls all the time for people. And all I ask is say, hey, just send me your personal tax return. That's it. I just need one tax return. Take a look at it. And I can probably give you $20,000 worth of tax saving ideas in a 45-minute call, right? Like that's all you got to do. Just book a meeting with someone. It doesn't have to be me. It could be anyone else in your area that you know, like, and trust, that you think might be at the next level. Just have them take a look. You'd be surprised what you might find out. The next thing you said here is that not all CPAs are equal. There's historians versus strategists, and that is also true. And this also actually applies even to that same idea of like your bookkeeper, accountant, tax preparer. Even at Ernst & Young, a big four accounting firm, there is a very big difference between strategy and preparation. And I would argue that even there, most of the accountants are really, really, really good historians, and not very many of them are good strategists. Now, there's ways in which you can tell if they're generally a good strategist, but that's besides the point here. The idea is that, yes, there are two totally different buckets. Okay. And you'll be able to tell if your CPA is a historian versus accountant by the way in which they interact with you. If they are a historian, the relationship will be very transactional. Send me the data. I'm going to input it. I'm going to send it back to you, whatever it is that you asked me to get you. You want me to do your tax returns? Give me the data. Here's my list of stuff I want from you, and I'm going to send it back. If they're a strategist, at a minimum, what you should get, if we're going to use the example of a tax return here, is at a minimum, they should be asking for your data, and then they should be sending you back questions saying, hey, I noticed this. Does this apply in your situation? Or, hey, I noticed this. Does this apply? Or, hey, have you ever considered making this small tweak? I noticed this in your tax return. Have you ever considered that? At a minimum, they would be doing those things if they're a strategist. And if they do strategy like our firm, it is a completely separate service, and we do an immense deep dive where we go we're going to go back as far as we can, We're going to give you everything that we could possibly do. I like to joke, past, present, and future, to save you money on your taxes. It is a completely different experience when you're working with a strategist versus a pure historian. Does that answer those questions for you, Krisstina?
It does, like beautifully answered. How does it look on the side of the CPA? Meaning, what is the difference between what you're doing behind the scenes and your typical accountant?
Well, I mean, the typical accountant is going to try and get 1,000 tax returns to complete and then try and get 100 more the following year. And then 100 more the following, and 100, 100, or 1,000 more. And just as many as possible, as quickly as possible, get them done. Whereas I have 100 clients. And that's it. I don't want or need more, frankly. And what it does is it gives me capacity to be able to slow down and think and go, I think this makes sense for so-and-so and so-and-so. Ooh, I just learned this interesting thing. I got to tell John and Jane Doe. Ooh, Jack and Jeanette Smith. I got to tell them about this one over here as well. Right? It feels very different from the way the firm operates and the work that you do at the end of the day from a CPA's perspective.
And it's more of a partnership where it's not
Certainly.
you're just talking in maybe December saying write everything off in the kitchen sink, and then I'll talk to you maybe in March. It's very different. So what are the type of conversations you're having, or what are you looking at? And are you meeting on a quarterly basis, a monthly basis, for example?
Yeah, good question. So what I do, I describe as personal CFO services, because I think it kind of encapsulates the types of experience that you can have. I'm not just a tax preparer. I'm not just an accountant for them. I'm their personal CFO. One of the lessons that I learned working at Ernst & Young was that the very best accountants for the wealthy individuals are the ones that sit at the top of their structure with them and can see the top from the bottom and work everything down. They're their personal CFOs. And so mechanically and kind of like blocking and tackling, what this really winds up looking like is that when clients first come and work with us, we do a ton in the first couple of months together. I typically call it like a launch, where we're going to do a deep dive analysis into their taxes and everything else in your financial life, because everything is connected from a tax perspective. We've got to make sure that all of our financial life is working in sync and that everything is working to drive us in the direction that you're actually trying to go long term. And then from an ongoing service perspective, I like to tell my clients it's a push-pull relationship. I'm going to be constantly pushing out ideas and opportunities and things that need to come up, and we're going to at least meet annually. But if you want to meet more than that and we want to have additional conversations, I have time for those, and I invite you to reach out to me and say, hey, Rob, I've got this opportunity. I've got this idea that just came out. Hey, someone just sent me, I just saw this on Instagram. What do you think about this thing? Let's jump on a quick call and let's have a conversation, or I'll shoot you a quick text message back, or we can, whatever it might be. It's a push-pull relationship. At a minimum, we meet annually. More often, it's more like 2 to 3 times a year we're meeting together.
So, all right. In lieu of time, I could really dive in deep and go a lot of different directions on that. But I want to get into this big, beautiful bill because it's passed just very recently and has some real impact. So let's first, as far as a W-2, where does the big, beautiful bill, what do W-2s need to know?
Well, the first thing that you need to know is that if you're in a high tax state, think New York, California, Jersey, Illinois, okay, your life just got infinitely better from a tax perspective basis. In 2017, with the Tax Cuts and Jobs Act, your state taxes deduction on your tax return got limited to $10,000 if you even itemized after that. Now, that got bumped up to $40,000 a year. Some of you high-income earners in those other states, you might have more than that in terms of your state income taxes, but at least now you're automatically now going to be itemizing because you'll at least be able to capture $40,000 worth of those state taxes every year. So that's the very first thing that I would want people to be aware of. From a pure W-2 perspective, if you're not doing anything from a strategy perspective, you also ought to be aware of the fact that a lot of the positive benefits from the Tax Cuts and Jobs Act actually have been codified now. They're officially going to be around forever. Things like the expanded tax brackets. What people don't realize is prior to 2017, the tax brackets were a lot skinnier. You jumped between ranges a lot faster. And now there's the big gaps between like the teen tax ranges to the 20%, 22, 24% tax ranges, and then the 32, 35, 37. Those big gaps are now codified. They're going to be official. So you're more likely to pay lower taxes because of the bigger gaps between those things, instead of just quickly and smoothly moving upward, relatively quickly. There's other simpler things, like if you happen to qualify for child tax credits and certain types of credits, those amounts are a little bit higher as well. If you're in a type of a job where you have tips and overtime, this is something that President Trump had touted during his campaign that he wanted to include. That did get included in the bill. It's not quite exactly everything he had talked about, but you still income taxes on those tips and can largely be eliminated. The QBI deduction is also going to be around. So if you're a W-2 employee with a side business, if it's any form of a flow-through business, think partnership, or if you're an LLC that filed as an S-Corp, or just a Schedule C business on your tax return, a sole proprietor, because of the 2017 Tax Cuts and Jobs Act, you were able to qualify for a qualified business income deduction. It was a little deduction that was created in order to try and bring corporate tax rates and personal tax rates a little bit more on an even playing field. If you remember in 2017, one of the big things that came out of the Tax Cuts and Jobs Act was that they dropped the corporate tax rate from the 30-ish% range down to 21%. Okay. Well, suddenly most individuals are paying 24, 25, 32%. They're like, wait, well, what the heck? Now I'm paying, if I have a flow through entity, I'm paying 32-ish%. This doesn't make any sense. And so Congress said, actually, that's a good point. All right, we're going to add in this random new thing, QBI, qualified business income, and we'll give you a little deduction of 20%. If you're QBI, you'll get to deduct against your taxes and hopefully generally lower your overall tax burden, even if the brackets are still there. And so that's become official as well, which is kind of nice because this is something that as us as accountants, we spent a lot of time trying to understand what the heck it was back in 2017. And it's nice to know that it'll actually stick around for a little while longer. If you're a high earning W-2 and a high saver, you ought to be aware of the fact that the estate and gift tax exemptions also got codified and the higher estate and gift tax exemptions are going to stick around. Prior to 2017, the estate and gift tax exemptions were about half of what they are currently. So that would have been about 14 million, let's just say, for a married couple filing jointly. But under the Tax Cuts and Jobs Act, that got bumped up to about 28 million now in 2025. Now that's going to be officially around. This is one of the things that estate planning attorneys were looking at really, really closely, because if this wasn't included in the bill, that was set to sunset at the end of this year. But now it's officially going to be there and be around and be indexed for inflation. So we can just expect higher estate planning limitations amounts. So in other words, if your net worth is less than $28 million, you no longer need to worry about estate taxes, which is really nice.
Right. Now, what about the business owner?
Business owners. Well, all the things I just described to you are still applicable as a business owner. There are some things you have to be aware of, but there are a lot more kind of nuanced things. I spend the vast majority of my time focusing on the individual tax stuff. So when it comes to the business owners, I like to joke 99% of business owners out there all flow through business owners. So all the stuff that I just described is applicable to you, period. One of the biggest things for business owners that you ought to be aware of is that bonus depreciation is back. Okay. Bonus depreciation, for those of you who aren't aware, was a nice new type of depreciation created in the Tax Cuts and Jobs Act in 2017, where it allowed you to effectively deduct 100% of the value of 3, 5, 7, and 10-year property. In the tax code, there's all of your assets, everything that you buy is a type of. Sorry, there's a fly that was in my room, so if I flick at it, I apologize. In the tax code, there are different types. All of your assets get thrown into different types of buckets and get different types of depreciation depending on what type of asset it is. And so the majority of business owners' assets fall into that 3, 5, 7-year bucket, which means that for all of those, you get to immediately expense them all in the year in which you make the purchase. Typically, you might have to depreciate them over 3 years or 5 years or 7 years. Now, you just get to expense it all if you want to.
It's an example of that, Rob, that if you have a business and you buy a piece of equipment,
Mm-hmm.
a piece of equipment, and before
Yep.
you choose how to depreciate it, and if it's $1 million piece of equipment, you can apply all the depreciation in that first year.
Correct. So depreciation is one of the beautiful paper tax saving tools that a lot of accountants will tell you, hey, just go buy something. And by the way, if you've ever had an accountant that just tells you just to go buy something to save money on your taxes, he's a historian. He's not a strategist.
Thank you for saying that. Thank you for saying that.
Because that's so true. That is the other lie that's out there. No, You don't have to just buy stuff. You can apply the principle of what I call zooming out to save big, which is take the profits from your business and go invest it somewhere else in some way that creates a complementary tax benefit that reduces your overall tax bill at the top, meaning at your level. Don't get so fixated on the one thing. You got to zoom out. Like I said, zoom out, see the rest of your financial picture. Either way, yes. So in a business, if you buy a piece of equipment, let's say it's $1 million piece of equipment, let's say it's a 7-year piece of equipment, like a Caterpillar tractor, and it's $1 million. Boom. Immediate 100% bonus depreciation. You get to take $1 million deduction on your business that first year. Pretty sweet. Now you have to be aware of what we call depreciation recapture. So if you sell the property within the allotted time in which you would have, so let's say, using the example of this tractor here, if you sell it after 5 years, you've got 2 years of that bonus depreciation you'll still have to recapture and recognize as income. So it's not perfect. You got to be careful. You can't play too many games, but just FYI, yes, you can deduct it, but beware of the depreciation recapture on the back end if you sell it early. There are other things as well in terms of like certain types of credits as well for business owners that have also come with the Tax Cuts and Jobs Act. There's some changes to a bunch of the energy and clean energy credits as well that business owners ought to be aware of. So like, for example, there were solar credits for putting, say, solar panels on top of your commercial building that you own. Those are being phased out. There were credits for putting solar panels on top of your house. Those are going to be gone as well. There's a bunch of green energy ones. I don't even have time to get into all of them, but generally, yes, there's a bunch of things there.
What about for the investor, like real estate?
So real estate benefits from that bonus depreciation that we were just talking about. If you do what's called a cost segregation study on a piece of real estate, and if you qualify to have your real estate be treated as active and not passive income, you can have that income offset against your earned income, assuming we're talking about business owners here or high earning W-2 individuals. Now, I think that's an important point to actually clarify there. By default, real estate is considered passive in the tax code. And this is not passive income like we read on like on the internet all the time. This is a specific type of income in the tax code. It is passive income, and passive losses can only offset passive income by default. So if we have real estate, let's say we buy a piece of real estate, let's say we do a cost segregation study on it, and we find out that 40% of the purchase price of this home is eligible for bonus depreciation. Well, that's $200,000 worth of depreciation. Let's say it's a $500,000 home, $200,000 worth of depreciation that we could offset against our W-2 income. Awesome. But if you don't use one of the 4 exceptions to qualify, you are going to that will not get to be able to be offset against your W-2 income. Instead, it will be banked for future years to be offset against the passive income. The losses don't get to offset active losses. Now, you can use either the short-term rental loophole, the real estate professional status, the material participation threshold, or the grouping election loopholes to effectively be able to get around that a little bit, but they are dependent upon your unique situation to be able to do that. But yeah, it's a great question. So the bonus depreciation is the biggest benefit, I would argue, for real estate investors this year with the passing of the big beautiful bill.
Anything else that's really big, bold, and beautiful?
From a tax perspective, I'd say those are the biggest things that you ought to be aware of. There are other things, of course. There's lots of little nuances that us accountants will geek out over. But at the end of the day, I think for business owners and investors like yourselves, knowing about bonus depreciation, understanding the QBI benefits that will come, understanding estate tax issues, understanding that SALT cap being unlocked, understanding maybe the changes of taxation if you happen to have employees that qualify for tips and bonuses and or overtime. I think those are the biggest things that you likely ought to be aware of.
And how does that affect you? Is that exciting to you? Is it just business, or do you?
I mean, it's always exciting when there's job changes, right? I call it job security. At the end of the day, let's be real, right? But I mean, yeah, it's always interesting and exciting. I mean, the 2017 Tax Cuts and Jobs Act was truly transformational for a lot of stuff in the tax code. Many of the things in the big beautiful bill are just either making permanent things that came around in 2017 or making slight adjustments. And so, yeah, it's interesting. It gives me opportunities to talk about things. I got to make some tweaks and adjustments to how I do stuff. But at the end of the day, a lot of the big changes came back in 2017. And so it's not that big of a change for me personally as an accountant.
Awesome. All right. Well, thank you for sharing that. And I've been waiting to actually have this conversation with you, to hear it from you as opposed to reading all about it. So thank you.
Yeah.
Now, that's obviously the big, beautiful bill. We've talked about the differences between a historian and a true tax strategist, and that you can outgrow your CPA. Where do you see, is maybe to wrap us up, if you can name a place where maybe, let's say, more historians, or I guess it doesn't even matter. That doesn't matter. Where are most people missing opportunities to save on their taxes? Like, let's say you take on a new client and they've worked over there, and then you're saying, holy cow, we've got a lot of opportunity here. What are the most common examples that you're seeing are being missed elsewhere?
That is a great question. And there are a host of things that I could say. I'm going to use an analogy first to kind of like illustrate, and then I'll give you specifics of each of these. So I like to tell my clients that saving money on your taxes is like playing Moneyball. You ever see the movie Moneyball with Brad Pitt back in the day? Great movie. If for anyone listening, if you haven't seen it, go watch it. It's a great watch. It's a great movie. Okay. But the general concept here in the movie is that Brad Pitt is the manager of the Oakland Athletics baseball team. And instead of going out and, because they don't have a large salary cap, instead of going out and trying to buy a couple of really big, expensive players that are going to really, maybe hit a bunch of home runs to make the team better. Instead, what they did is they used statistics and data to find players that consistently got on base, that consistently had hits. And if they got enough of those guys on a team together, they realized with the law of averages and things, they could actually have a really good baseball team. And that's what happened. They did very, very well. They didn't have to have the big names to be able to succeed. Okay. And saving money on our taxes is a lot like that. It's really fun and exciting to talk about the grand slams and the home runs of tax savings. So it sounds really cool and sexy, and it's awesome. But realistically, you're only going to have a couple of those maybe each year. Okay. You have to have both, all your guys getting on base, and you have to strategically set yourself up for those other opportunities. But do ones that specifically make sense for your situation. So, the bunts and the base hits, maybe even the doubles, these are what I call tax leaks. Everyone's got them on their tax return. There's just little things that just kind of eat away at your taxes. They could be simple things. It could be things that you've probably even heard of. Things like, hey, I didn't max out my 401k, or I didn't max out my HSA, or I had a change in spiking years of my income and I could have used a donor advised fund to get the most out of my charitable donation strategy. Or, maybe I'm a small business owner and I'm still filing as a Schedule C sole proprietor, and I should be using an S Corp election to save myself some money on my self-employment taxes. That's more of like a double. That's what I call that. Okay. I mean, I had a client, she was making over $1 million a year from her Schedule C business and still was not an S Corp. We're talking hundreds of thousands of dollars paid, saved in taxes and just amending 3 years worth of tax returns, right? Like that. It's just a leak. It was a simple thing. The accountant was just reporting, hey, they've always done it this way. This is just what their income was. And this is what we got to do. But it was hundreds of thousands of dollars with one simple adjustment. Just close that leak. Okay. But then we want to strategically set ourselves up to be able to take advantage of those triples, home runs, and maybe a grand slam every once in a while. Okay. And the way that we do this is doing a couple of different things. One is we need to structure our life in a way to be able to capture specific types of benefits based off of where we're trying to grow our wealth and the types of assets that we have. And we need to apply that principle that I talked about before earlier, which is the zoom out to save big. Saving money on your taxes isn't just a 1 year thing of I've got to go right here into my little business. I'm going to save my money on my taxes. It's like, okay, yes, chill out, zoom out, see the big picture. Where are you trying to go? If we could take money from one place, take those profits and invest it somewhere else to create the life that you want long-term and get a complimentary tax benefit, that's a win-win. Or we could take the money from over here and put it to work over here and at least do it in a tax-efficient way so that it's not going to throw more taxes on top of the pile. Okay, that's what we have to do to start to get into home runs and grand slams. That's where we really start to move the needle for ourselves. And this can be simple things or it could be more complex things. Simple things could be like, hey, I know that I want to own real estate. Okay, great. But I want to make sure that I do it in a tax efficient way. So I'm going to take some money in my W-2 job or my business that's growing, and you know what? I'm going to buy the building that my business is in. Okay, great. Let's make the grouping election to group together your real estate with your business and make it so that all that passive, default passive losses that you get from your real estate now gets to be offset against the active income of your business. Boom. Now we have an asset that's creating cash flow that's now shielding the income from our business. Beautiful. We just applied the zoom out to save big. But now we also need to combine that with how do we structure it? What entities should be owning what? We probably should have some form of a family investment holding company that's holding our real assets, and we should have some form of what I call a family enterprise business, some sort of holding shell company that holds all of our business interests. And as long as they're held separate, similarly, we can do what I just described. Not a problem, but it has to be structured right. And there's reasons for doing it both from a tax perspective and from a legal perspective. I could give you more complex examples. So let's just say you want to do a leveraged charitable tax equity play. This is a way to put $1 in and get $5 in charitable deductions out. If you're a high income earner, that's like the equivalent of putting $1 in and getting $2 back in your pocket. I'll take a 100% return every single year that I'm willing to get that. Thank you very much. Yes. And it's very simple and easy to do. I won't get into the details of it because that's, I think, too much for a podcast, but I think you get my point here, right? Like there's little things that we can do to always close the leaks and find tax saving opportunities. But then the big stuff comes down to structuring it and seeing the big picture. Where do we want to move and create wealth in other places and do it in tax efficient ways?
Yeah, I thank you for sharing all that. And I'm smiling because somebody had asked me, I don't know, maybe about a year ago, but they said, who's your best financial advisor? Like, who do you work with? And I said, my tax strategist, my accountant. And it was just went over thinking, oh, the best financial planner is helping, I don't know, put the money in the right index fund or put it in the right investment, so to speak. And that's kind of their wealth planner, their wealth strategist for, somebody not in the uber wealthy category, but a really high income earner. I'm like, I don't have one of those, but my relationship with my accountant is my wealth partner.
Agreed.
And when I was saying that to a small group, and they're like, oh my God, I just never thought about that way. And, I was just saying a few things, in my personal experience that had saved on taxes, and it blew everybody away. So I just appreciate you saying that, because for everybody listening, that from my experience, like working with Rob, if you're a high income earner and your business is growing and it's scaling and you think you're kind of at the place, you need some tax strategy or just wealth planning, the first place to start is with your tax strategist CPA and get that, like you said, big picture, zoom out to zoom in. And you're going to probably find more money there in the short term, like in the now, versus, maybe working with a typical advisor over 40 years or something. So anyway,
I would totally agree with that. That's one of the reasons why I left the wealth planning world and came back into my accounting world, because I realized there was so much value that we were providing to our clients. Most people just didn't think about it. They just didn't, or the standard historical accountant didn't do it. But so much we could provide. Can you mind if I give you some hard numbers here that could be beneficial, an idea? Absolutely. So I have a client who is a doctor, successful doctor, does very well. Came to us, was making over $500,000 a year. I was like, hey, how do I lower my tax bill? We asked some questions, figure out some things that some investment asset classes she wanted to invest in, applied those principles of structuring her life the right way and zooming out to save big. And we saved over $150,000 on our taxes in 1 year. I just described to you the client that was making $1 million a year from their Schedule C and saved $300,000 over the course of the last 3 years on your taxes. You cannot tell me that some financial advisor out there with $1 million account is going to make you $300,000 in a single year, or $150,000 in a single year, or even $50,000 in a single year, I would argue. Good luck.
Well, thank you. To close this up, Two things. Number one, if you are going to try to bust a myth when it comes to accounting, CPAs, tax, what is the big myth out there that you just want to scream from the mountaintop and say, no, that's not
Oh
true?
man. I mean, I've already shared a few of them, even in this conversation, right? Like I already mentioned the idea of the myth of if you're a W-2 salesperson or W-2 person, you can't save any money on your taxes. That's a lie. Or, hey, just go buy more stuff for your business. No, that's a lie. um, maybe that might be the right answer. But for the biggest myth, oh man, those are my first like go-to. Here's one that I'll add that I'll just say here. Well, maybe it's just a play off of this first part of our conversation, which is not all accountants are created equal. Period. Hard stop. You might not be able to watch the game like you can a basketball game, but I promise you there is a big, big difference. And you might be costing yourself more money than you realize by not just asking around a little.
Finish us up. If there's a entrepreneur, smaller business owner listening that their business is growing, they're maybe earlier on in their career, so they've got a long way to go with their business, but they're super ambitious and working and smart, and their business is growing year over year, but they're not there yet.
Mm-hmm.
Are you still a good person to talk to that kind of more on the business age, the early stages of the business to start that so that they can, grow, you can grow with them, they can grow with you?
Oh, certainly. And in our firm, we do tax strategy, we do your tax prep, we can do your bookkeeping services, we can do anything. We can grow with you along the way. The examples I gave were for, very high income earning individuals, but I have plenty of people that I work with and have helped and served who are far below that, and that's fine. At the end of the day, I love helping people get to great outcomes. And sometimes the best, we call it tax planning, not tax reacting, right? Some of the best planning can be done at the very beginning of your business to set you up for long-term success. Even if it's not like, oh, I'm just going to, fill in the accounting here and do your basic bookkeeping. Some basic structure stuff, some basic GL ledger setup, some basic organization around your business and understanding your longer-term desires, goals, and trajectory can be very, very valuable long-term for you.
And you've offered everybody listening a complimentary strategy call. So I'm going to put a link to that in the show notes to make it really easy for anyone that's just blown away by Rob and wants to pick his brain and see if he's a good match for you. So I'll put that link in the notes, but just real quick, like who would be a good person to create a situation for somebody listening? Like if you're in this situation, I can probably help you in this 45-minute complimentary session.
Oh yeah. I mean, I have a little infographic that we're getting prepared to kind of put on our website because we have this general data. I'll tell you right now, I've never saved anyone less than $10,000. Well, okay, let me take that back. Technically, and there's two people I've ever talked with. One, it was like $50 under the $10,000 mark, and another person, it was about $1,000, and that was because they're right out of college and they wanted to have a conversation with me. However, for my average client, if you're making $300,000 a year or more, on average, we save those clients anywhere from $25,000 to $30,000. Very, very regularly. And often it can be far more, especially as income grows, it can be significantly higher. It all, of course, depends on situation and complexity. I was talking to one client the other day. Sometimes if your tax situation is very, very simple, it might be on that lower end. Maybe it's $20,000 that we can save you. But if you're willing to introduce a little bit of complexity, I promise you we can go much higher. It just depends on what you're willing to do.
Thank you so much. I appreciate your time, spending time with us, sharing your genius, and we'll make it really easy for anyone listening to connect with you. So thank you.
Thank you, Krisstina. Thank you so much for having me on the show.